Most people think gold prices move on fear, wars, crashes, headlines. But the single number that tracks gold prices more consistently than almost anything else isn't a headline at all. It's a quiet figure buried in bond markets called the real interest rate. Here's what it actually means. The real interest rate is simply the nominal interest rate, the rate you see advertised on a bond or savings account, minus the rate of inflation. If a bond pays 5% and inflation is running at 3%, the real return is only 2%. That number, not the nominal one, is what actually reflects your purchasing power. The market actually prices this directly. U.S. Treasury Inflation-Protected Securities, known as TIPS, trade every day and their yield is, by design, a real interest rate already adjusted for expected inflation. Economists and traders watch the TIPS yield as a live readout of where real rates stand. Now here's why this connects directly to gold. Gold pays no interest and no dividend. Holding it means giving up whatever a bond or savings account would have paid you instead. That's called the opportunity cost. When real interest rates are high, that opportunity cost is high, and gold becomes less attractive relative to interest-bearing assets. When real interest rates are low, or negative, the cost of holding non-yielding gold basically disappears, and demand for gold as a store of value tends to rise. This relationship shows up clearly across decades of market history. Periods of low or negative real interest rates have tended to line up with strong periods for gold, while periods of high real interest rates have tended to weigh on it. It's one of the most studied relationships in commodities research, discussed extensively in World Gold Council reports and academic finance literature. Like any single relationship, it isn't a perfect predictor. Central bank buying, currency movements, and geopolitical demand for a neutral store of value can all push gold in ways that real rates alone don't explain. Real interest rates are best understood as the dominant long-run driver, not a precise short-term trading signal. Here's why this is worth understanding even if you never trade gold directly. When you hear that the Federal Reserve is cutting or raising interest rates, the immediate question for gold isn't the nominal number, it's what's happening to real rates once inflation expectations are factored in. That's the version of the story that actually explains the move. 3 things to take from this. Real interest rate equals the nominal rate minus expected inflation. That's the number that matters, not the headline rate. Gold has no yield, so the opportunity cost of holding it rises and falls with real rates. And this is one major driver among several. Geopolitical demand and central bank buying matter too, so it's a lens, not a standalone forecast. Gold headlines love to talk about fear and crisis. But underneath most of those moves is a quieter number that traders have been watching for decades: the real cost of holding cash instead of metal. We track the financial traps that don't make headlines so you're never caught off guard. If this helped, subscribe. We post every day. I'll see you in the next one.